do you like about this? It's got a straw built into
shut
it.
Up about this
It's got a straw built into it, or so you can sip or you can tip.
You can start.
I'm drinking.
Sanj that and be like,
she would like that, dude.
no,
Sanj,
I want one.
Oh yeah, and then Chris was bragging about his too.
Just so I can lose it.
It's a sip and tip.
Are we ready?
Computer's purring. All right, let's
sneeze.
get this thing going. Hello, everyone. I am Robert.
I'm Chad.
We are Intellectually, the show where we teach you how to hold us professionals in real estate accountable. So we're going to get this started. This is part 1 of a 4 series we're going to try, and it's all about investing, right?
Indeed.
So if you are looking at, potentially investing in real estate in any form, we're going to focus 4 parts, starting with the real estate's point of view, location and area. We're then going to move over to lender's point of view, then maybe a contractor's point of view, and then we're going to try and get the insurance side of it on that 4-part series. Do keep in mind this is going to be around residential. We will then approach commercial if you guys give us good feedback on this. So use and abuse us, whatever. We're obviously not going to get as deep as you need to get in this industry. So reach out to us after each podcast or after any show, anytime, and we'll be happy to go deeper into the topics we're talking about with you. So that being said, you guys like to run the show.
Not true. He likes to say that. But we will... Again, started with the residential investing. We'll break that down in kind of 2 designations. I'd say long-term investing and short-term investing. Also, mainly specific, I want to point out this is mainly for single-family homes and multi-family properties up to 4 units. So really anything up from 1 unit to 4.
Why is that?
Well, there's different lending regulations when it comes down to...
You misunderstood my question. Why are we only focusing on max for residential?
Because once you get over 4, that gets into commercial. We're getting into apartment complexes, everything down those lines.
Yeah.
We'll have a separate series on that.
Yeah, so just to be clear, we are talking about residential units, so zoned in residential, not zoned in commercial. And they that means that they are a residential abiding area that can fit up to 4 different units, 4 different families, all in one building, right? And that building being said, how can I put it, is all owned by one individual, right? So you see these 4 units, 3 units, 2 units, all the way down to 1 unit. That is what we mean when we say residential investments or residential properties. Anything more, like you said, Chad, is going to have to qualify under commercial zoning.
Sure. Yeah. No, again, we broke it down into long-term and short-term. When we speak about long-term investing, we're talking about rentals, rental properties specifically. You have your tenancy for years, which are your long-term leases. I would say roughly 6 to 12 months.
So you're talking about the long-term investing. We broke it down into 3 that you want to focus on, right?
Yep. So we have first one's rental properties.
Okay.
Right, which either can be broken down into the tenancy for years, which is long-term, 6 to 12-month leases. You can have midterm, which you kind of see more in like Furnish Finder and whatnot. See a lot of...
What is Furnish Finder?
Furnish Finders is a midterm rental service, kind of like I would say an Airbnb, right? Where
Fair enough.
It connects you with... a lot of uses for in the medical industry, right? When you have residents coming in and they're traveling for short periods of time, to do their residency or whatever they're following, they'll need a lease for maybe 3 to 4 months. I'd consider that midterm rental.
Yep.
And then
basically the Airbnb kind of.
And then you have short-term rental, which is the real
Airbnb.
Short-term rental, which is Airbnb, right? When you're staying at maybe a
hotel
days
living for residential
exactly.
zoning, right?
And then when we talk about short-term, I really think there's really only 2 in the real estate, and it's either you're going to flip your property, or you're going to wholesale it, which wholesaling is a whole nother different type of short.
Well, I can elaborate on those 2. So you just went through the first form. So we broke it down. 2 types of investing techniques when it comes to residential. If you're going long term, you're thinking of renting out your property on maybe an annual lease or a 6-month lease.
Correct.
And then you might be thinking midterm, and what you were elaborating on is a lot of companies that like to conduit, help connect you with those short term, or they'll furnish the property and maybe rent it out to nurses or short-term living professionals. And then you get down to the Airbnb level. and that's kind of short term when it comes to that hotel feel. And then you just said if you're looking at the short-term investing
Correct.
strategy.
Yes, I can see why that was a little confusing.
Just wanted to,
Definitely.
the short-term investing strategy, we're not saying that you're going Airbnb because that's still long-term.
Because you're holding on to the property.
Yeah, you're still hanging on to
People
the
are
property.
renting it for short periods
Yeah.
of time, but you're owning it for hopefully long periods of time.
Exactly. So yeah, when you're thinking short-term, the strategy for a short-term goal is 3 months, right? Bad time, 6 months. Monster, year, maybe 2 years where you're just like, what the heck happened, right? If you're short-term investing, you never want to think a year with this property. You don't even want to think half a year. So that being said, you're looking at flipping properties. You have a keen eye. You have a good party in your belt that you can trust and efficiently rebind the house to a living status and most likely modernizing it to make it attractive to that next buyer or that next renter. And then you have the other side, wholesaling. And wholesaling, you'll find if you go to try and sell your property and it's a distressed property, wholesalers love to jump on those. They'll lowball you, which is, they're offering you money. If you're selling your property, be educated enough to know what your property value is at. But they will attempt to go under contract with your property at a lower price than market value. And then they will attempt to assign, they will attempt to reassign that contract to another person for a fee, right?
So they're essentially buying and selling contracts.
Yeah, exactly. So they're
They
basically
really don't ever own the property.
Yeah, they're mediating. So if you have a wholesaler, you can really tell that they're a wholesaler when they have ideas like, hey, I have the ability to extend this contract, renegotiate, or if they're, we like taking on distressed properties and we're going to give you this amount of dollars. You can also tell a wholesaler just by the brokerage that represents them, because wholesaling in general is a hefty task. So those brokerages usually just prioritize wholesaling as their business. So if somebody comes along and says, I'm with so-and-so Realty, look into that real estate brokerage. And if you see nothing but distressed properties, flipping contracts, and advertising, take this contract over, yeah, you're dealing with a wholesaler. They're not bad. As long as they're organized, they'll get your property sold quicker than you will. But just know, if you're signing a contract with them, you're likely selling your property less than market value.
Sure.
So might as well hire a real estate
whether or
agent
not
at
that's
that
going
end.
to be your thing, something you're interested in or not, it's good to know, right? We are listening to these things because one of the first and one of the most important pieces of getting into real estate investment is also understanding what's out there and what type of investor you want to be, right? Are you going to be a long-term investor? Are you going to be a short-term investor? Do you want to deal with the house flipping? Do you want to wholesale? You know, it's good to understand all of the different types that are out there so you can really figure out and have a plan of action when you do start your investing.
So true.
Career.
And it's daunting, right? It's good to be organized when you're approaching this because not everybody does it for that reason. It can be too much. So it's important to kind of lay down the foundation for what you want to do and be prepared to understand you have allergies. This man's got allergies all day. He's been sneezing all day long. Yeah, and it's the cat. But the idea is when you're approaching this, it's important to be absolute about a lot of I just hear him sneezing back there. It's important to understand your absolutes so you don't have to worry about those being unknown. What did we have for our next one on there?
So we are looking at, so you guys were talking about long-term.
We were talking about long-term, then we went to short-term. And then what was the following one after that? He's got the notes, but he's currently blowing his nose.
If you want to kind of talk about like single family.
Oh, okay, yeah. So types of properties we had listed down there, right?
All right.
I love it.
Sorry about that.
I don't know what that was. But so we kind of moved on to the types of physical investments that you could be making, right? Now that you've decided whether you want to be a short-term or a long-term investor, you then start looking at what kind of product you're going to be investing in, right? And so what did we have listed down there?
Multifamily or single family?
Multifamily or single family? Okay. So I had multifamily broken up into 2 brackets. What were those?
Yep. We've got 3 to 4 unit versus 2 unit.
Okay.
So multifamily, anything over one. Anything that can
Multifamily,
house
anything
one
over
family.
1, but if you want to stay in residential, it's got to be 4 or less,
Correct.
right? So no more than 4, but obviously multifamily, so you're going to be at least 2. 2 properties do not have to deal with this rule if your buyer is an FHA. Here's what I'm saying. If you are looking at investing in a 3 or 4 unit property and you are looking at purchasing it with an FHA loan, you're going to have to deal with a new clause or a new standard that actually started in 2024. Don't hold me to that. Was it 2024? Yeah, it was 2024.
so.
Yeah, either the beginning or very end of 2023. It's called the self-sufficiency clause, right? And that basically is stating the lender needs to know that the income on this property, gross income before any costs, is how can I put it? Let me restart. The mortgage on this property is at most 75% of the gross income that comes from the property.
So we'll break that down a little
Yeah,
bit. If your
glad-
mortgage is $750 a month, low mortgage,
You better have $1,000
you
in
need
gross
to
income.
make sure that your your rental income is at least 1,000.
And that's a rule that can jeopardize your FHA loan, right? Now, that being said, FHA loan requires you to live on the property for at least 1 year. Deed of trust will require you to live on the property for 1 year. So the question that might pop in your head is the dogs are wrestling, so it's kind of funny. It's always something going on. Chad's nose, Clyde's crying. Now the dogs are wrestling. They're going to tear something apart. But anyways,
FHA.
yeah, FHA buyers have to live in the property for 1 year. So you might ask the question, well, if my gross income needs to be at least, say, the mortgage has to be 75% of my gross income, me living in that property is going to decrease the income, right? Because I'm taking up one of those potential income units. That's okay. The appraiser just has to go out to the property and verify what this property's potential income is. And that's how the lender is going to verify that the gross income on this property is, I like to say 125 to 130% of the mortgage, if that makes sense. So that being said, that's why I like to bracket that 3 and 4 unit property into its own bracket versus the 2 unit. And then there's the other thing. When you have an additional unit, insurance companies are going to require some kind of fire separator, what you might hear as a firewall, something that can negate the ability for fire to kind of transition over to another unit. It's just one extra safety layer, and that can be in a very expensive process if that firewall has been broken or was never there in general. So think about that when you're also investing in 4 units and 3 units, because they can get more expensive in that regards. We'll dig into the insurance parts and of course the lending parts that I just spoke to a little bit deeper into the future podcasts. But that's so that's the first thing. And then you got your 2 units, and 2 units is obviously the most of where you can start doing that house hacking mentality. So what is house hacking?
I was going to say, what does that mean? House hacking is a great tool.
Yeah.
You may have heard of it. It's been a fad, especially the past 5 years. Become very popular. And very,
The phrase has.
The phrase has.
Yeah.
The idea is, especially too, when we kind of going back to the point of FHA loan, right? There's a lot of benefits to using an FHA loan, but one of those requirements is the fact that you do live in it. Now, regardless whether you get an FHA loan or not, living in one of those units, buying a rental property or multifamily and living in one of those units is the concept and the idea of house hacking, right? You have multiple units on a property and you're living in one. So you are renting either one of the 2 units, maybe 2 of the 3 units, or maybe even 4, all the way up to 4 units. You're living in one. Not only are you getting rental income, right, from those other units, but whatever the difference is between your mortgage and that rental income is essentially your own personal mortgage payment that you're making to live in your own. Think of that as your rent towards the apartment or the unit that you're living in, right? There's a lot of benefits to this house hacking that we have.
So the aesthetics of the house hacking is renting out a portion of your property so you don't have to either pay the full mortgage or some of the mortgage. Now, that being said, hint, hint, don't get all excited about house hacking. We've talked about this in the past. We've got a lot of investors, particularly in Dogtown of St. Louis, that I've seen, in which properties are shooting up in value. And that house hacking mentality is where you get an unseasoned investor. They're going to buy this property and get a $3,000 mortgage. And then they'll rent out one of the units for $1,200, thinking, now, wow, this mortgage was $3,000, but now it's only $1,800. This is great. I only have this $1,800 I'm building investment.
When you move out.
When you go to move out and you find out that you can only rent your unit out for $1,200, you're in the negative.
Just say even $1,500.
Yeah, I obviously went extreme. That I can't see somebody falling into that purchase, but it does happen if you don't do your numbers correctly. If you're trying to house hack, which is a very healthy thing to do, just make sure your finite numbers are correct, because you might get yourself into an area where down the road your mortgage has shot up with taxes and insurance, and you find yourself renting out one unit for not 50 to 60% of the mortgage, but maybe 40% of the mortgage, and you find out you can only rent your unit out for the other 40, and you still got a 20% of that mortgage left over.
So you're talking a lot of numbers right now.
Yeah.
Let's kind of go into detail about some of the. Do you want to go into some of those details on what numbers you need to look out for, everything that is involved?
Do you want to do that yet, or do we have that written down?
What do you?
We talked about the 4 major ideas. Did we have those written down?
Mm-hmm.
The rules of thumb when it comes to investing. Did you want? If you want to, we can go there now. You
Sure.
want to?
Absolutely.
Cool. So what are the 4 major rules of investing? Let's start with 1.
So one would be cap rate.
Cap rate.
Which is
Did we have that down as a universal rule? What were the ones that popped up?
Like GRM, DSCR, those ones. Yeah. So GRM would be your gross rent multiplier.
So gross rent multiplier, right? Did so when it comes, what is the gross rent multiplier?
Chad, you want to
it's
take on?
it's the amount of your monthly rental income.
Yeah.
It's the purchase price or the purchase price of the property divided by your monthly rental income.
Yeah.
It's going to give you a number, right? And let's just say, you have buy a $200,000 property.
Yep.
And you get a sweet monthly rent of $2,000, right? What is your gross monthly rent? It'd be 10.
Yeah. So your gross rent multiplier is more
Gross rent multiplier.
foreseeable. Yeah, more foreseeable number that you can use to compare. You come up with your limit of what you're trying to do. It goes along with your capitalization rate. Arguably, anybody who makes an investment loves to sit their assets around in a 10-year projection, right? And that's usually because of the 10-year bond, which is what most of your major investors kind of rely on when it comes to manipulating where their portfolio is. We can get into that long term.
But this is essentially saying how many,
Yeah.
and I'd say in terms of years or months, is it going to take for you to recoup
Your investment.
your investment?
Yeah.
The amount of money that you spend on the property based off the rental income that you're having, that basically
Yep.
puts a number, a numbered value on that. Obviously, the higher the number, the better.
Yeah, absolutely. Now, there was that wasn't the first one that I was anticipating. The first one was the 1% rule, correct?
You've got your wires all crossed here, my friend.
Maybe. What is it?
No, you do. But we have, so the 1% rule,
Yeah.
it's goes along the lines of the gross rent multiplier, but you want to make sure that your monthly rental income is at least 1% of the purchase price of the property that you buy it for.
So yeah, that being said, the 1% rule, gross rent multiplier, when we looked it up, I apologize for this. Some of the major calculators, I was just trying to get the rules of thumbs down. The 1% rule is a commonality that a lot of investors use. It's not
Very
one that
common. I'd say is very popular right now.
Yeah, I'm not a big fan of it, but it is a good point to start at. And that's basically something that tells you you're in the green if it's 1% or more. And all you're doing is you're saying, what I'm going to make each month for rent, I want to divide it by the price that I invest in this property. And if it's below 1%, things can be a little iffy. If it's above 1%, then I'm looking good in the green, and I at least have one of 4 rules of thumb down. That being said, right, When it comes to the price that you invest in that property, I highly advise that you don't just take the sale price that you purchased that property for as your number. If you're going to buy a property and then plan to maybe put $20,000 to $30,000 into it and say it's a $300,000 property, you spent $330,000. So like I said, if you plan to put $30,000 in, you should not be taking your projected monthly rent and dividing it by 300. You should be dividing it by 330 after all your money's been invested, right? And I always like to overestimate that because costs are never the way we expect them, right? Murphy's Law. You're going to move in there.
Your purchase price is going to be looked at differently, and then you got to look at your mortgage payment, right? What else is going to be included in there? You got taxes, insurance, right?
Oh, yeah.
All added on top of the purchase price.
Yeah.
Right. Things that you need to be cognizant of.
Yeah.
And understand that those things are subject to change. Those things are subject to go up, as we've seen, especially taxes.
No, I feel you. I feel you. So this is actually the calculator that I like to use, and it's one that our sponsoring brokers actually created. It's called landlordcalc.com. Landlordcalc.com. Let me pull this up real quick because this is what I was talking about, that these are good rules of thumbs, right? So we got the 1% rule, and then we got gross rent multiplier. See, I don't got my stuff screwed up. Scroll to the bottom. Yeah. There they are in order right there. But yeah, no. So we already went through the gross rent multiplier.
This guy's confident in something he doesn't understand.
No, I was just talking about the order. No?
No, you're right.
Yeah.
About this.
Oh. But so what was our third one? Was the DSCR. What does that stand for?
DSCR.
Debt service coverage ratio.
Okay. So we kind of hinted at this one, right? When did we hint at it? When we were talking about that self-sufficiency clause. The self-sufficiency clause actually does the debt service coverage ratio for you, doesn't it? Do you know why?
Sorry, I was.
No, you're good. So what is the rule behind the debt service coverage ratio?
If it's greater than 1,
Yep.
or if it
good.
equals 1, or if it's less than 1.
Okay. Your targeted goal is what, though?
1.
Universally. Your targeted goal is 1.25.
1.25.
I prefer 1.3, correct? Now, that being said, the self-sufficiency clause requires what?
1.25.
Yeah, your mortgage to be 75%, thus your income on the property to be 1.25 higher than your mortgage rate.
And to get a little bit of clarification on
Yeah.
exactly what this means, DSCR, debt service coverage ratio. A DCR of less than 1 is that the property generates more cash than is required for debt payments,
Yeah.
indicating financial strength and lower credit risk. If you have an equal to 1, the cash flow exactly covers all debt obligations, leaving no margin for unexpected costs. And then if it's above 1, cash flow is typically inefficient to meet the debt obligations, signaling potential risk. For
Yeah.
sure.
So the reason I'm not a big fan of 1% on the DSCR is because 1%, it's kind of like if you were in a boat and you were floating in water, you would literally put enough stuff to where the water is right on the edge of spilling into that boat. Or let's say you're walking with a cup of water and you filled it right up to the top. Nobody's going to do that with their glass of water, right? So that empty part on the cup of water is kind of that 0.25 or that 0.3, right? It's kind of to protect you, because what usually happens to taxes lately? They go up.
and up.
What has been happening to insurance lately?
Up.
Yeah, it's been going up. So it's crazy to say that 1% is healthy, because likely your taxes and your insurance is going to go up, which is going to increase your mortgage, and now you're negative. You're below 1%. So it's very important not only to go to 1.25 but to 1.3. That also being said, when it comes to investing in a future home, especially as a house hacker, I like to tell my clients, make sure you're 1.3, because if you go to move out and buy your forever home, your lender needs to see that property you own as not negative equity. Does that make sense?
So you want them to count it as income.
You want them to at least count it as break even. And a lender is not going to take 100% of your income. They're going to, on average, take
25%.
75, maybe 80% if they like you, right? So if they're only taking 75%, by you making sure you have a debt. Why can't I think of the acronyms?
DSCR.
Yeah,
debt service
DSCR.
coverage ratio.
Yep. As long as you're at 1.3, you're actually setting yourself up for future lending benefits,
And
if
you
that
should be
makes
thanking
sense.
these lenders for
Yeah.
having that requirement because it only helps you out.
Yeah,
as an
exactly.
investor,
Yeah, well, they
right?
don't.
Gives you a buffer, right?
Exactly.
That you want. Then they want to see you making money. Everyone wants to make money.
Yep. So that being said, 1.3 is what I'd recommend. So you have wiggle room for taxes and insurance to increase, but you also have the ability to still make sure your mortgage is only 75% of the income on the property, so you can invest in a new property. Hint, hint. We could talk about this with lenders. If you try to count your property as negative equity or in any way like that, it will affect you negatively when it comes to invest in a new property. So couple things there.
Stay
But
tuned.
yeah, that was winded. I apologize for that. I could tell you guys were, Hannah was starting to glaze over. Hannah's in residential and she does operations. She's like, I don't care about it.
So next up
What
would
do
be
you
our
do?
50% rule. No one knows what I do.
What were you saying?
50% rule.
So a 50% rule, this is my least favorite rule because these days it's like almost never beaten. And if you're over the 50% rule, then you might as well not worry about the other three,
I don't know what that means, Rob.
right?
Oh,
So
what
what is
does
the
that mean?
50% rule? Elaborate.
Well, it would essentially mean your operating expenses consume 50% of your gross income.
Yeah.
Correct.
So your net is 50% of your actual gross income. If your net on the property is 50% of your actual gross income, I would argue the others aren't really going to matter. You know what I mean? If you're getting into a property where you're losing 50% to operating expenses, different utilities and stuff, then, you know, I don't know. You
So in
wouldn't even be
layman's
qualifying
terms,
those
over
other-
50% is not a good thing.
Yeah. So if you're making $1,000 a month in rent on this property and it's costing $500 a month to upkeep it, absolutely. But
Are you including mortgage, principal, or all these insurance? those
no,
payments
you
as
would,
well?
yeah, you would include insurance and you would include taxes, but you wouldn't include mortgage and principal
Just wanted to
traditionally.
make that clear.
Well, principal is what you paid on it. But that also being said, the reason I don't like this rule is 50% is way too high,
Yeah.
right? You know, you should be trying to keep that closer to 35%. And if it's over 35%, you need to be concerned, right? And I would walk away from that property or at least consider looking into what's going on with the current ownership, if that makes sense. So that one's pretty basic. You guys did bring up capitalization rate. You brought up the idea of what capitalization rate is. It's a 10% investment outlook.
A lot of these are just a lot of ways, different ways of saying
Capitalization
that in
rate.
some ways, like gross rent multiplier and all
Yeah.
these, right? It's your net operating income divided by your purchase price. That's how you get the cap rate, right? And you multiply it for.
Yeah.
5%,
Sorry, I got
10%,
confused when you said net
right?
operating. Yep, you're exactly correct. Well, it's your annual net operating
Correct.
income. Yep. So that being said, the reason you care about capitalization rate is for competitive measures, right? Because the capitalization rate is going to help you understand what the average area is willing to pay for a house, right? So right now in St. Louis, the average capitalization rate, if you go into, I brought up Dogtown, for example, right? With unseasoned investors that are trying to house hack and just somehow get into a house as quickly as possible, they're making unintelligent purchases, which has shot up the prices of the property, which has increased the capital, or which has lowered, the capitalization rate. We could dig deep into it, but just know one of the quickest ways to decide if your market is, if the house that you're currently purchasing is a good market value, just see what its capitalization rate is. Take the net income after everything taken, all costs taken away, and then multiply it by 12, and then divide it by the purchase price of your property. And if you're seeing that the capitalization rate in that area, people are willing to invest in a property under a 7% capitalization rate and your number falls on 7, you're good. If it's above 7, you know, you're even better. That being said, more expensive properties, it's okay to have a lower capitalization rate. Less expensive properties, you want to push that capitalization rate up higher. Finally, 10 is that sweet spot. 10 means if you have a cap rate of 10 on a property, 10% that is, that means you will be able to recoup all your invested money in 10 years.
So if you spend $250,000 in 10 years, you will have made $250,000.
You will have made 250,000.
Generated, I guess.
Yes.
Generated $250,000 from revenue from
Yep.
the property.
Yep. So that one's in depth. We can dig deeper into that. Just, yeah, I wanted to address capitalization rate when it came in.
And so
Yeah.
you kind of were getting into like the idea of the 10-year rule
Mm-hmm.
when you said that, which isn't like really a rule, just something you kind of go off of.
Well, I like the 10-year rule because once again, it's the bond market has a lot of investors follow the 10-year yield on the bond, and that's where they're going to decide when to diversify their portfolio based off when, the 10-year bond is going to change,
Did
go
you
up
say
or down.
Portfolio?
Portfolio. Yeah, it's a good word. Portfolio. But so that being said, if you're trying to not make things chaotic for your portfolio, it's kind of nice to keep your investment time frame the same as all your other portfolios. I need
Stop saying that word.
I need burials. But so that's why I like the idea when you're looking for a capitalization rate, 10% means you're going to pay off or you're going to recoup your investment in 10 years.
You just have so many goodies with you. You have an Owala, you have a squeaky ball.
Well,
It's not your squeaky ball. It's someone else's squeaky ball.
she's just right here.
Didn't see her, just saw the ball drop.
That ball's gone. It's gone.
Anyway.
Thank you. It's back. So yeah, that's a big set of ideas to unhatch. But what I guess we would be trying to get through to you is if you can master those four and then understand your market's capitalization rate, your competitive capitalization rate in the market, altogether 5 ideas. If you can master those, you'll actually be able to search the market, private market, public market, look at a property and be like, that's worth my time or that's not worth my time.
That you made that sound a lot easier.
Well, I did say master.
Yeah.
To master something is very hard, right?
So when you talk about, how an individual can go into a neighborhood and look and determine, how to generate these numbers and get their numbers, how do they do that, right? What is the first step when you're out there looking for what type of investment property, what area you want to be? How do you determine what the value of a property should be, right? What numbers are you looking at?
Yeah, so I mean, obviously, if you're investing, you need to understand realistically what you can actually make on a 1-bed, 2-bed, 3-bed, 1-bath, 2-bath property, right? You need to be able to categorize those properties into modern, outdated, usable. What kind of
Location.
yeah? Pardon?
So
Location.
understanding what the rental market it is
Yeah.
in a certain area.
And I wouldn't rely on somebody. You can do it yourself. It is difficult to get absolute prices on the rental market like you can in the sales market, right? In sales market, you can hire a real estate agent, and we got some background MLS logs where we can go in and articulate the exact price somebody paid for after all costs and everything. In the rental market, that's a little bit different because a lot of rentals just rent out without any
Not a ton of
process.
data out
Yeah.
there on the MLS for us.
Yeah, so there's major sites like Redfin and Zillow and apartments.com that advertise these properties, but they are advertising them. They're not giving the numbers that they're renting out for. And then you can hire an agent who can go into their MLS and see different properties that have been rented out on the MLS, but it's not going to give traditionally enough data. So my rule of thumb is I kind of get a gut feeling as well what the market is asking for, what renters are asking for, how long that property that's currently requesting this much a month is going for. And you can kind of really understand reality from how much you can make. We also talked about vacancy rate a little bit. Do you want to move on to vacancy rate? How much time do we have?
We're at 34.
Okay.
So I guess I'm trying to figure out where we started when we were talking about
No, that's fine.
vacancy rate, which also I wanted to kind of talk about location as well, because I feel like that can play a huge
Well,
factor.
and
Perfect.
because vacancy rate plays a factor in how you gauge your cap rate. right? And all of these things, it's a certain number that you include
Yep.
as far as an expense.
Yep.
Right.
So we
An
talked about, you
operating
said
expense.
this St. Louis average on vacancy rate is what?
At the end of 2025,
Yep.
quarter four was sitting at 10.5%.
10.5%. And my argument was what?
It's difficult to even gauge that information, but your argument is, why is the vacancy rate so high?
Why is it higher than like maybe the
no-
old traditional 6 and 7%?
Well, you're also asking the question is, why do people leave, right? Why do
Yeah.
people leave their living situation? Usually it's because prices are going up.
Yeah, rent's going up. And I think you have uneducated investors that are purchasing these properties and hoping to get top dollar out of it. Or even worse, you have property managers that are telling you this property could rent out for this much. And I'm not a fan of that, because you're trying to squeeze as much as you can out of this property instead of getting a healthy, consistent number on the property and getting a tenant that's willing to live there, renew. And if that tenant moves out, you have a competitive price. So I'd hate to say that vacancy rates are higher because St. Louis is struggling. I just think we have uneducated landlords that might be asking $50 to $100 too much for their unit, right? You lower that down, you lower your asking price down, you lower your vacancy rate. And we always talk about consistent, confident money is a lot better than inconsistent, unconfident money, especially if you're trying to manage a large business or portfolio.
So when then that poses the question, well, Rob, there's not very many investment properties out there that are priced to the point where I can make a healthy amount. So,
I think there are. I think,
and you're right. I'm saying from
Yeah.
me as an average consumer,
Yep.
act like I'm not in the industry, right? Everything I'm seeing on Zillow,
Oh, yeah.
on Realtor, everything I'm running the numbers, everything is just way too high. Everything's super overpriced.
Yeah, they are kind of high when it comes to investment properties, definitely during the hot season as well.
So I guess my real question is,
Yep.
what is your advice as, or at least to the seller's perspective in these investment properties when they're looking at the value of their
Yep.
property versus the buyers who are trying to make money off of this, and then they
Yeah.
see these prices, and there's just not a lot of room.
So the advice that I'd have to buyers during their search, right? These properties are expensive. If it's not hard, you're doing it wrong, right? If it's not hard, then you're in the wrong industry, I would argue, right? Or at least you're handling the industry incorrectly. It should be difficult, especially if you want to be successful in it. And the other part is, it's very difficult to list a property that you're motivated to sell and lose income on without getting a hefty lump of money to justify that. So an investor these days, if they have a property that's worth $250,000 and they're making a good income, and when I say worth $250,000, I'm saying like it's hitting all those check marks that we had of the 4, and it's got an above competitive capitalization rate, and this puppy would sell well for $250,000 and it would be a healthy investment. Why would they want to let that property go? They wouldn't. They would want to keep that consistent income because they got a good deal going. So you got a lot of sellers in the investment realm that are selling their properties simply because
They
they're
want to. They don't
because
need
they're
to.
trying to make money. Yeah. But if you search healthy enough, you're going to finally find that investors that's like, I'm not trying to sell this property to make money. I'm selling it to you.
I don't want to do this anymore.
Because I'm done with it, right?
I don't
I'm
want to
done.
be a landlord anymore.
Yeah, I'm
tired of
done. I'm
fixing
ready
the
to
same
retire.
toilet.
Yeah. So it's important. It's important just to understand why they're selling it, what they're trying to do. Investors, like people trying to diverse their portfolio, those are healthy investors I would argue to buy from. Not always, but I've purchased properties personally from investors that were just diversifying their portfolio, and they're like, hey, here's the price. We did the math. This is what we're looking at. And then you got the other investors that are retiring landlords, and they're like, hey, I'm done with it. Like, let's negotiate all this stuff. But then you're also going to have those other investors that are just like, I'm trying to make some money. The market's looking good. I think I can make a lot of money, and I'm, willing to sacrifice this income for it. That being said, If you're getting into this industry and you're not ready to negotiate, you're not ready to hold your agent accountable to negotiate on your behalf or hire a well-seasoned and negotiating agent in the field, then I wouldn't get into the field in general, right?
Of
Because
investing, you mean?
yeah,
Yeah.
don't get into investing if one, you're not willing to work with an agent who knows what he's doing. Don't try to cut costs on your agent. If he's going to get in there and try to negotiate, you better sure as heck hope that he's willing to also take some money off your hands to do what he does best or she does best, right? And I also advise, if you're going to work with an agent and enter in the market, don't expect that agent to be your teacher, your guide for something that he's not going to be around after the sale takes place. Know your own stuff. Be able to converse with your agent correctly. Now, I'm not saying that you shouldn't get education or advice from your agent, but I'm just saying, don't expect to be naive throughout the entire process. Expect to know what you're doing as well, because that agent's not going to be around forever. If that makes sense. Did I say that correctly? Cool.
No, you're good.
Helps you hold your agent accountable. Make sure they know what they're doing and they're taking care of you the way that they should.
Yep. When it comes to investing, an agent should be more of a partner. He should not be an absolute counselor and advisor like an agent on a residential sale or even some commercial sales, if you will. Especially if you're looking at multi-investing. So keep that in mind.
With that being said, I think we should wrap up with Chad's factor myth. Chad?
Our factor myth.
Before we do that, didn't you have some location ideas that you just wanted to avoid? Just run through them real quick.
Yeah, so some key key
concluded,
location indicators to avoid. Yeah, when you're looking at buying some properties. I'm just going to kind of quickly run through these. One would be declining demographics, which I think we kind of talked about a little bit. Vacancy rates we were talking about, high crime rates, lack of economic diversity, poor infrastructure and amenities in the area.
Yep.
And then there's also some risk factors to look out for. High risk areas, so avoid areas, flood zones, environmental risks, things like that, areas that are maybe prone to natural disasters.
Yep.
And then something actually was kind of new to me was C-grade neighborhoods, so any areas with lower tenant quality, high turnover, things like that.
Yep. So C grade is more of a lending kind of factor, and that's just the condition of the house.
Yep.
So they're saying when they talk C grade, they're talking about properties that are
More
borderline
maintenance
boarded
required,
up.
maybe, yeah.
Boarded up properties, properties that are incredibly out of date. You might see some tears on some. Yeah, it's just really, it's what you would call a can of worms, right? So yeah, you take it from there. Sorry to cut you
We'll
off.
start with the declining demographics, right? Decreasing or increasing population. It's very important that you are doing your research and seeing what the area that you're looking to invest in. Is the population decreasing? Is it slowly increasing? What is going on around it? Are there amenities in place, right, that people want? Are they building amenities that people want? Is this an area that people want to be? And you could tell. Are people moving there or are people moving away
Drive
from it?
through it, right?
Right?
Drive through it several times. Drive through it at night, drive through it during the day, walk the areas, go to a local cantina, just have a conversation, talk to the neighbors. These simple things really, we all have proper gut feelings, and it's very good to do something like that. You'll hit a harsh reality and you'll have a much easier time finding that diamond in the rough. Yeah.
Another kind of little secret we do too is on Google Maps, you can kind of take a look at the street as well.
Well, there's another cool
Sometimes.
thing. Yeah, right. Google Maps street. But you can also, when it comes to the history of the property, below on the bottom of Google Maps, sometimes, as long as they've consistently had drivers go through there, you can go back in years and you can see how the property's been upkept, and you'll be like, oh, that property went through a house fire or something. You're like, this looks like they cheaply installed this or that, and you'll just see kind of the condition of the property through those years. Kinda
That
cool.
will always kind of determine too on independent what kind of investor or landlord you want to be, right? More in an urban area, you're probably going to find yourself with a higher rent turnover, right? You're going to get more people in those areas renting. Multifamily multifamily units are really popular in these areas. Maybe if you're in more of a suburban area, right, you're going to find yourself more popular with single family homes. People want better school systems.
So
out
just
there.
understand,
Right.
how your property fits into its surrounding properties.
And again, what kind of landlord do you want to be in, or you want to be, right? If you're in a college town or you're in the inner city, you're going to get a lot more turnover, right? You're going to have to fill your spot with more tenants. You're probably going to have a higher vacancy rate, whereas potentially in the suburbs, you might find that long-term tenant, right? That individual that may, and it doesn't necessarily subscribe to suburban and or urban, but again, typically I'd say nicer areas, you get more longer-term.
My personal sweet spot is right between universities and hospitals. I like those best, right? Because then you're going to get that adaptation of traveling nurses, incoming doctors that, are looking for a house to buy, and or students and young professionals that want that place to live. Those arguably students are, I don't know, I've always had incredible luck with students. They're very patient, they're very understanding, and they're not hard to deal with. They're very,
especially here in specifically those medical students, right? The ones in grad school.
Yeah, the ones that don't have time to. Yeah, they're just always
out of the way.
I had some tenants once that the student. I was purchasing a house, and we were checking out the property and everything. And the bottom unit was lived in by a young professional, and we were testing things out. I was like, the water's not getting hot. And they're like, oh yeah, let us look into that before you buy it. Of course, they were very hospitable to the idea. They come back to me. They're like, the water heater is broken and has been broken for 4 months. I'm like, holy cow. And we talked to the tenant, this young professional. He's like, yeah, I've never showered here. I always shower at the gym. So I didn't know that I didn't have cold water. But it's that kind of level. Some young professionals, I'm not promising this, but I've had so much luck with students and young professionals. They're just like going with their life and stuff. But yeah, that also being said, understanding your location is also understanding the kind of property you want to project as well, right? If you are looking at long-term renters, you're probably going to want more bedrooms. You're probably going to want more family-oriented ideas, right? But if you're looking for college areas, I'd prioritize more bedrooms, but maybe a couple extra bathrooms and ideas like that. Family-oriented areas, they look for bigger bedrooms. College students and stuff, I find, don't really care about the bedroom size. They care more about the living room and the usability of that, maybe a nice basement or something like that. Always, I say this over and over again, if you plan to invest in areas like this, also recognize you probably shouldn't cheap out with the materials you put inside the property. If you buy a nice stove, I know some people would kill me for this recommendation, but I highly believe this. If you buy a nice high quality fridge, high quality stove, put high quality countertops and give a premium look and feel in your property, you will attract more conscious tenants. And from that, they will be more cautious around your products because they don't want to pay for it if they break it. And they also just respect that living style. Everybody likes that premium. If someplace is clean, you're going to be more conscious of it, right? It's kind of like I always thought about the idea when I walk into an antique shop and in the glass area, I'm like very astute, I don't touch anything.
Now, we're not talking about the highest and most luxurious options.
Yeah, but I'm just saying, don't be afraid be afraid to put some money into this property and risk it and receive less.
A couple extra $100 for the stainless steel. People like
yeah,
that. They want that.
Something I definitely, I think attracts more qualified tenants that are willing to just take care of your property, if you will, right? Yeah. So, what else do we got?
Do we even want to have time for this?
We're almost at 50.
We should probably cut it short. We could save it for the next one.
We can. No,
you want to do it?
This is good for our whole.
Oh yeah,
our whole phase.
Yeah, our whole series.
This one definitely took some different turns. So I feel bad for the viewers and listeners that are going to try and keep up with us. So please reach out if there's any things that we talked about. We tried to leave it a little bit more broad so you could personally reach out to us. We're happy to work with you one-on-one, really help delve into these ideas. We got a lot of clients we've worked with in the past that these methods and adaptabilities that we've helped them with have made their lives 10 times more efficient, right, in decision making when it comes to investing in properties, particularly around residential, if that's what you're looking for. But other than that, my name is Robert.
My name is Chad. If you like our podcast, please donate some Allegra.
Allegra? Yeah.
So I don't
for Chad's nasal cavity.
Get up and sneeze during
Please donate some Allegra.
This podcast. But yeah.
Like and subscribe and donate some Allegra. Cool. Thanks, guys. We'll see you.